Yeah.
Okay. All right. Hi, everyone. Thanks for joining us today for our Briefing Trader webinar on mapping major global trends. I'm Mike Midland. I run sales of Briefing Trader, and I'll be your contact for those of you taking a trial. I'll be joined today by Brett Manning, who posts his trading calls and analysis under Chart. We're going to do a quick walkthrough of Briefing Trader, and I'll highlight where to find Brett's work on the site. Brett will then discuss the major themes he sees potentially developing and how subscribers can capitalize on them in the coming months. Lastly, we're going to do a Q&A session. So if you want to ask Brett a question, use the chat window on the bottom left, and he'll try to answer them on the webinar. If he can't get to all the questions, he'll respond by email and post answers live on Briefing Trader as well. Okay, so let's move over to Briefing Trader now.
Can you see okay, Mike?
Yeah, I can't. Yeah, it hasn't come up just yet. So on the screen here, we'll wait for that. It may take a little bit to load. Okay, there we go. It's starting to share. Yep, it's coming.
Okay.
Okay. So we're now on the Dual and Play page, which is the layout for Trader, guys. It consists of a split screen where you have live streaming news and market coverage on the left, and then you'll see the proprietary trading calls and analysis shaded in yellow on the right. Brett trades under the ticker Chart, so you're going to see his calls stream live as they come through in the site, but you can also do a search for Chart in the search window. Yeah, if you could blow, for some reason it's very small, Brett. So if you go up into the search window on the top right, you can do a search for Chart, and you'll see any of the trades or analysis that Brett has placed today or for the past few days. You also have the ability to get live email alerts or visual and audio alerts whenever he places a trade. This is done by going where the portfolios and email tabs is on the top. All you have to do is add his ticker chart to your portfolio and allow you to get live email alerts as well as a visual alert, which will be a window popping open for 2 or 3 seconds, or an audio alert, which would be similar to Siri saying chart whenever Brett places a trade or has some commentary or analysis. Okay, so now let's move over to some of Brett's research. He writes 2 columns for Briefing Trader. These are both found under the Investing and Trading tab. He does a daily column called ETF Daily Notes. This is his daily pre-market macro view of the market. It comes out roughly 15 to 20 minutes before the open and will detail which asset classes to focus on and where the best trading opportunities will be each day. In addition to that, Brett does a monthly macro chart book, which is under Industry Insight under the Investing and Trading tab. This is an intermediate macro view of the market that will correlate and focus on fundamental and technical analysis as well as sentiment and hedging data. So as we scroll through this a little bit, you can get a feel for the depth and detail of the research here. And Brett will get into all this in a minute and how this interplays with the market and the levels we're at now. Okay, so those are the key areas where Brett is going to be posting his commentary and trades. Another great feature of the Trader service is access to any of the traders and analysts. You can do this in one of 2 ways. We have a Talk to Us button on the top right, which will open a window and allow you to ask questions to any of the traders. You just type in their ticker there and leave your email. Or if you don't know which trader to ask, you can just put your question in and we'll forward it to the appropriate trader or analyst. We can also set up a call with any of the traders if you have some detailed questions. In addition to that, the other way to access the traders is by emailing briefingtrader@briefing.com. So with all this, if anyone has any questions about anything on Briefing Trader or would like a demo to customize the service to their trading approach, you can just email me at mmidland@briefing.com. So with that, I'm going to toss it over to Brett now so we can get a feel where we are in this market and where the next big trade might be developing. Okay, Brett.
Okay. Thank you very much, Mike. All right, guys. Hopefully this is all working correctly on the technical side. So thanks for joining me today. We've got a ton to cover, but it should be painless and hopefully it'll be very interesting. The theme today is decidedly macro. It's about getting perspective. And I want to give you the benefit of my 20 years at this and my view. And that's shaped basically through a particular understanding that I've developed with behavioral psychology, behavioral economics, game theory, kind of working together to form a sort of emergent phenomenon of cyclicality in market prices and economic data. And I know that's a lot of big $10 words, but they do add up to something important. So this perspective has been increasingly useful for me. It's been keeping me on the right side of the market. We've had a lot of really interesting turns in this cycle, but having a really big picture perspective that then feeds down to a more narrow perspective with little benchmarks for monitoring data to keep you sort of in the flow of the cycle has made a huge difference at certain key moments. So my name is Brett. I've been doing this for a couple decades, and my experience runs the gamut of different kind of perspectives on it. And I think that so I got started maybe in 1998 or so, 1999, right sort of in the crescendo of the dot-com bubble. And I think that just going through the experience of watching that top form as a new trader and then watching the big bear market that followed probably had a big impact on me, because the difference in the psychology at the top during that period with the type of psychology at the bottom as sort of my formative experience really showed me how important that kind of crowd psychology is in driving everything. And I think that kind of set the terms for how I started to approach things. And so we're going to kind of take from that perspective and build on everything that's happened in between. And so today, here's what I want to cover. Think about it as sort of a zoom function. We're going to start really, really, really wide, super long-term forces. We're going to get the context and framework of financial and economic reality, and then we're going to start to zoom in, right? We're going to zoom into this cycle. We're going to zoom into the recent couple years, and we're going to zoom into the present, and then we're going to look forward. But along the way, I'm going to take a little detour, and I want to talk about turtles and weather for about 5 minutes, because it's the best way that I've found to capture what I think is most essential about why we have cycles, why there is a cycle, and why it's important to be on the right side of it, and how that works and what drives it. Okay. And the big point, the reason why this is important, all right? If you use 4 basic building blocks, you can keep on the right side of things. There's a structural context. There's cyclical reasoning. There's a real process that's going on there, right? There's key tools that are relevant to that process specifically. It's not, every data point's not going to help you. There are certain tools, right? The process has to do with a reflexive relationship with risk in a group, right? And there are tools to monitor that, and you want to look closely at them. Sentiment data, hedging data, credit data, rates, market patterns, behavior, right? And then praxeology, basically the science of how people make decisions, okay? That drives a lot, and this is it's important even if you're a day trader, because honestly, I've done a lot of day trading, and even when I've had a great year, it's really been about periods where volatility kicks up. There's some really crazy things going on, but you've got a big enough perspective to stay on the right side of things. When your bias is right, those are the moments when you can really take advantage and have some really big days. And in the end, it's those big days that drive your results for a big year. Okay. So here is the really big picture perspective on things, and that's structural forces, all right? And I want you to consider an analogy here to understand the difference. First of all, it's really important to understand the difference between structural forces and cyclical forces. And the difference, here's my analogy for that. Imagine Golden State Warriors are going to Cleveland to take on the Cleveland Cavaliers in a basketball game, okay? The analogy for that would be the structural factors of the ball is round, the court is made of hardwood, it's happening in Cleveland, you have to dribble, the hoop is 10 feet tall, and LeBron James is out with a toe injury. Those are all structural forces. They provide the parameters, the context, right? The terms of the battle. The cyclical forces, that's the game itself. Who wins the opening tip-off? Is Steph Curry hot from 3? That's the cyclical battle, right? That's the cyclical forces at play, how the game goes, what happens during the course of the game. But the structural forces are the context. They set parameters. They limit what can happen. And I'm about to show you exactly how that's playing out for this cycle. The structural forces that I think are most important here, they're all deflationary, first of all. That's why all this QE, that's why the Fed has had to act like it is, that's why interest rates are where they are. And I can prove it, right? We've got a deflating credit bubble that took maybe 20, 25 years to build. We've got a demographic transition that's one of the biggest forces. It's sort of like a valley between two mountains. And we're passing on to that second mountain gradually right now, and I'll show you that. There are other forces. Automation, software is eating the world. We are finding ways to really make certain labor really, really cheap so that people can no longer get a career in it. And the applied phase of the IT revolution, where everybody's geared with all of these devices. And the fact that the last crisis was inflationary is actually important too, because all the decisions we've made since the 70s have to do with getting away from that boogeyman. And that's led us on a road right into the hands of the other boogeyman. And that's how it works on a big time frame. And I'm sure that we will make decisions now that gradually head us back into an inflationary crisis at some point. It's just the way it goes. So the first point, the structural context here, we're going to look at the credit bubble. I said this has been forming for 20, 30 years. You can see it right here. And one point I'd like to make first, you see a lot of big scary numbers about debt, and that's real debt, but it's not the same thing. This debt is the kind of debt that causes the deflation. This is private credit out by banks. This is banks lending to people, companies, et cetera, right? It's different. The really gigantic scary numbers come from things like domestic corporate bond issuance that's happening against gigantic cash accounts overseas for mega cap companies. That's just not the same thing, right? It's not the thing that means the bill is coming due kind of problem. Okay, so you have to keep perspective here. Or the Fed lending to the Treasury. These can lead to gigantic numbers when it comes to looking at where we are in the debt cycle. But the really important thing to focus on, the simple, clean data point that's not misleading at all, is just private credit out from the banks to the private sector. And you can see here, this is what shapes daily life, in other words. This actually has an impact on how people, hiring decisions, spending decisions, and it's in a structural decline now. And you can see the acceleration got started in the mid-1980s. You can see where it popped up through the 100% of GDP level, right? Right, this black line is where it became above 100% in GDP. And then it goes into a new gear in the late 1990s, and I think everybody's credit looked so good. The growth was so fantastic that banks were willing to take a lot of risk. So they really pumped it up. And in the next cycle, we had from 2003 to 2007, essentially the time when financial engineering was the driver of the economy. So we really ramped it up then. With the housing bubble, mortgages, et cetera, we built something that got close to 200% of GDP in bank private credit. That's impossible to sustain. So it started to break and bust. And I think that I'm going to show you probably the most important reason why it did when it did, although there's lots of other stories to tell there. And, we've all read books like The Big Short, and, they definitely capture it very well. But this is a factor that you may not realize was there, and I'm going to show you how important it is. The demographic situation that we have right here, plotted out, I think it's the best way to look at it. So what this is it's effectively the baby boomers passing the baton on to the millennials, right? The blue line is the annual growth rate for the civilian labor force. It's people who are aged 25 to 54 years old, okay? And it's the annual rate of change. So that's the blue line squiggling across the middle of the chart. And you can see when it goes up the slope here, this is the baby boomers really coming in big time. And you can see the two other lines, right? There is the green line, that's inflation, that's CPI. The red line, that's the 10-year treasury rate, the so-called risk-free rate of return on investment. And the big point I'd like to make here is you can see a very obvious correlation there. And I think it's really important to understand that the blue line is an independent data point in this series. The number of people who are 24 years and 364 days old turning to 25 years old is dependent only on the sun rising the next day, right? That's not dependent upon any other economic data. So the number of people, obviously the number of people born at any one time is somewhat dependent upon the economy around when they were born. But in an immediate sense, right? The number of people in the civilian labor force and the year-to-year change is not caused by economic factors at that time. Yet there is a correlation, and so I would suggest that you can make the statement confidently that the annual rate of change in the civilian labor force is probably the primary long-term cause of changes of inflation and interest rates, okay? Now you can see where it dips below zero here. There's a minor breach here. The red line is zero, year-over-year change of zero. So this goes negative in 2008. And again, that is not caused by anything going on in 2008. It just happens to be that that's when it did. And it stays down there for, you can see this period here. It's basically the period when the Fed had to do a lot of QE. That's when the civilian labor force is shrinking. And at the end over here, you can see it pop back up. What this is so the millennials, they're actually a bigger generation than the baby boomers. And the millennials is defined, the big birth swell for the millennials is pretty much 1983 to 2001. So the median age is right now is around 26 years old, born in 1991, right? The median bulk of the millennials generation is just starting to come into the civilian labor force right now. Now, if you look at that process for the baby boomers, it's important to know that the prime spending years for anybody we know is pretty much between when you're 40 years old and when you're 50 years old. That's the decade when you tend to produce the most and spend the most for anybody. And if you take the median point, the boomers were 1946 to 1964, with a median year of around 1955, okay? So if you take a 10-year band around that, you got people born from 1950 to 1960. When you look at when those people went from 40 years old to 50 years old, that's 1990 to 2000. So when the bulk of the baby boomers were doing the bulk of their producing and spending in life, it was the boom that we had in the 1990s. So I think you can pretty much set your watch by it. For the millennials, that's going to be 2027 to 2037. That's about 10 years from now. And so this, by that analogy, is basically kind of like 1980 for the baby boomers. And it's odd, coincidentally, that we just had an election where so many people are comparing it to the election in 1980. I don't know if I necessarily agree with that comparison, but it's commonly compared to that. So my big point here, more than any of this, is so you can see the impact on this cycle that the valley between these two gigantic generations has caused for us as a society. You've got lots of really young people or really old people and not as many people in the middle supporting them, right? That's 2008 to 2012, an irregular time for us as a society. You can see how important that is. And so my big point is just understand that that's a driver, right? Now we're going to zoom in from there armed with these ideas. We've got this deflating credit bubble. We've got this kind of valley that we've gone through demographically, and we're maybe coming up the other side of it now. Now here's the cycle. Here's the S&P, started basically March 6th, 2009, and in this rip-roaring trend that we've seen, I want you to note the two red arrows because there's an important shift that goes on there. I'm going to get to that in terms of the specifics in just a minute, but it's, I think, just important to note that there's these two really critical points that we're going to talk about, and it's sort of everything changes through there, and it becomes a different thing. And all of this, again, the point of all of this is to understand where we are right now with much more perspective. So that's what I'm trying to help you guys see. This is another way to look at this cycle. And I think that if cycles had like a personality and an ego, this is the chart that would make the current cycle feel kind of embarrassed, right? You can see the prior two cycles, see the big boom, see the rates ripping off the lows. This is the short-term interest rate, so you can see the reaction of rates to what's going on in the cycle. And the reason why this cycle looks like that is because of the two things we looked at a moment ago, the deflating credit bubble and the demographic transition. That's really the main reason. You can just look at it. It's that simple, right? That's what's going on. That's why this has been so hard. That's why the Fed has to pump so much money in. That's why, with all the QE, with everything we've done, gold has been largely a bad bet. It's not that we're putting stuff into a normal situation that's then going to cause this massive inflationary boom, right? The Fed is being pressed down by this giant deflationary force, and they're doing everything they can to try to fight against it. And for a lot of this time, they were losing. And I think that we're starting to see a transition, but it has to do with the next thing we're going to talk about. And that's when we get to my little metaphor here. So bear with me for 5 minutes. This is the best way that I've learned to try to describe what cyclicality is. So we talked about structural forces. So now we're going to talk about what I think is the quintessential thing going on with a cycle, right? Why we have cycles, why there is that cyclicality to things. And there's a lot of good work on this, and there's some common, the good versions of the common argument, explanation, is that it's short-term debt cycles mixed with central bank policy, right? But I think there's something more essential underneath that. So I've constructed this, kind of little metaphor to try to get that across. Okay, so I want you to imagine a beach, right? And it's sort of off in a void. It's not attached to anything. It's just a beach. And on this beach, there's a population of turtles that live there. And these turtles are kind of interesting. All they care about is the weather, right? That's the only thing they care about at all. And, so when the weather gets better, they come out of their shells. When the weather gets bad, they go into their shells. So for the turtles, they're really just responding to that weather. If it starts to get really bad, they see that it's really bad, and they react by going into their shells. If it starts to get better, they see that it's getting better, and they react by coming out of their shells, okay? Now, the twist to this is sort of a magical beach, and on this beach, the weather is actually controlled by the turtles. So all the weather is doing is reacting to the turtles. When all the turtles are in their shells, it causes the weather to be really bad. And when all the turtles are out of their shells, it causes the weather to be really good. So if you imagine lightning bolts, the rain's pounding down, sky is dark, all the turtles are huddled in their shells, and one of them just kind of sticks a toe out. And the rain lightens up a little bit. And then another one kind of responds to that, noticing it, and sticks a foot out. And the rain stops more or less, starts to drizzle. There's a little blue poking through the sky. Another one sees that, sticks his nose out, and a ray of sunshine pops out. And there's a feedback loop there now that's started. And that feedback loop will run its course all the way until it's brilliant sunshine and they're all out of their shells. And I really like this picture on the right, because the turtle's out of his shell. He's not just out of his shell, though. He's actually got a for sale sign and a little party hat on. And I think that the for sale sign is interesting because effectively what this is saying is it's the extrapolation phenomenon, the belief that things are different now forever. The weather will always be good now. I don't even need a shell, right? And that's a real top if you think about the kind of the metaphor there. And there's another way to put this that's done even better by Sir John Templeton. Long time ago, he said, bull markets are born on pessimism, grown on skepticism, they mature on optimism, and they die on euphoria. And to me, I think that pretty much says the same thing. It's just a different way of putting it. But I want to show how this plays into everything. It's more than just about the market, okay? If you think of the turtles, the narrative is that spectrum. At one end is extreme risk aversion, and at the other end is extreme risk acceptance. And there's this feedback loop. And it has to do with how households deal with things, how banks deal with things, how companies deal with things. It goes through everything. And so if you think about what risk aversion really is and what risk acceptance really is, let's look at it on a household level. It's really about assumptions. So for somebody who's earning a paycheck, they get paid every couple of weeks, and they need to buy, they want to buy. Let's say they want to buy a new TV. Right, that's going to come down to whether or not they think they're going to have their job in 2 weeks, or if they were to lose their job, is it easy to get a new job, right? I mean, that's really the fundamental question. If somebody's looking around themselves and they decide, it's pretty easy to get a new job, or, boy, I know that I'm really a superstar, the business is picking up, we're seeing a boom where I work, there's no way I'm going to lose my job. So now you don't have to save money from your paycheck anymore because there's more money coming, right? So you can get a credit card, go to Best Buy, buy the TV. There's no risk there because there's more money coming, right? That's a decision that's about risk aversion or risk acceptance. And everybody's making decisions like that all the time, and they're perceiving the world around them. It's a bit like the turtle coming out of his shell, right? So for banks are thinking, well, they see the economic data is improving, right? They see somebody's paying their bills all the time, so they're going to extend them more credit. When somebody's doing well, they're going to have an easier time getting credit. And when the bank sees the environment is better, they're going to be thinking greedily. They're going to be thinking about how they can make the most money. How they can make the most money is to put the most credit out there possible while they believe default rates will be very low, right? So they're going to enable even more buying power out there. And so that person's going to have an easier time going to Best Buy and buying a new TV. And when they do, Best Buy is going to do better, right? And the salesman who gave it to him is going to do better. And so that person now is going to feel more confident about their job and going to go get a credit card, going to go get a car. Who knows? But it feeds on itself. And for companies, for corporations, they're thinking, wow, I just sold those 2 TVs. I may need to sell more. I'm going to need to make more TVs, get more TVs. I'm going to need to hire more people to sell all the TVs I'm about to sell, right? And when they do that, all the people they hired suddenly feel better about their jobs and they're going to spend more. The whole thing, all 3 pieces feed on each other. This is how the private sector works in an economic boom. It all feeds together, and all of it is this movement along this spectrum. Extreme risk aversion on the one hand, extreme risk acceptance on the other. The households, the banks, the companies, they're all those turtles, right? And as they respond to their environment, it feeds back, and their movement causes the weather to get better for everybody else. So that causes somebody else to come out of their shell, which causes the weather to get better, which causes somebody else to come out of their shell, which causes the weather to get better. It's just a big feedback loop. So that's the cyclical dynamic, right? So if we go back to the big picture view, we got a structural context. And in the structural context, at any time, there's always going to be a cyclical dynamic. So the structural forces form the parameters. And the cyclical process I've just described takes place to the extent it can within the framework and the parameters of the structural forces, right? So now here's just a couple of quick points to make about this cycle and some interesting ideas. Household debt to GDP, people say that we've just gone back into another debt boom. No, we haven't. Every single year since 2008, households have delevered relative to GDP. That's the simple stat. You can get it from St. Louis Fed. Household debt to GDP, anything below the black horizontal line is a year-over-year decline. Right? This is up to the present. Every single year, it's shrunk. It's shrunk by less and less amounts. And I would expect there to be a flourish coming up where we're back above that line soon. I think that we're turning a corner as far as the turtles in this particular cycle. But the narrative of this particular cycle has been, kind of negative memes, I think, generally speaking. I think that we're kind of seeing an environment that has been like a wall of worry, not just in the markets, but for everybody. And I think it's sort of like a post-traumatic stress disorder from what we went through in 2008. Okay, so there's another stat kind of like that, by the way. If you see prior cycles, here's what bank lending has been doing. These are the banks in their turtle shells. This is year-over-year change again. So in prior cycles, just getting down to 5% was bad, 5% credit growth. We have just barely gotten up to that point this time. Right? We've gotten up to what is the bottom of the cycle in most credit cycles. Just gotten there now. So that's part of why it's been so tough to get bigger data too. But this, of course, is in part about delevering. It's about the ball we were handed to play this game. Okay. Sentiment data. So I talked about data. You need to monitor kind of where we are in that spectrum. And I think that attitudes about the stock market, attitudes about financial asset markets among the general population convey something about their feeling about their own lives and about the world around them. And so I think that sentiment data on markets is one of those markers of where we are in the process of the turtles coming out of their shells before we get to the real point where people have had too much optimism, they've taken on too much risk, they become vulnerable. That's when the cycle is over, by the way. When there's that vulnerability, you have to get the necks stretched out. You can't short a market when the turtles are in their shells. You're not going to get anywhere. And we'll see that in just a second. But this is what I watch as far as sentiment data, just to run down a list. This is the small and large options trader positioning. LOBO and ROBO, that stands for a large buy to open put call ratio. So large only buy to open. So big traders initiating options positions. And ROBO is the retail trader. So retail only buy to open. And this, by the way, you can get from sentimenttrader.com. Jason Gepford is a friend of mine. He does an excellent job. I would highly recommend their service. Futures trader positioning, the COT data, commitment of traders. put out by the CFTC gives you a sense of things as well. Volatility, expectations of volatility, and the VIX term structure. The VIX term structure, the VIX futures market has a term structure. It has contracts that expire, and the price relationship between the current contract and a contract 3 months out or 6 months out tells you something about the degree to which people are afraid of what's about to happen next. Okay? Odd lot short interest tells you about people who aren't big market participants. When suddenly there's a ton of odd lot short interest, it's usually, your next door neighbor deciding he's going to short Google, right? And when you see a ton of it, it tells you something about how people are feeling. The surveys, American Association of Individual Investors and Investors Intelligence, I tend to think AAII is more interesting because Investors Intelligence, I know from the writing that I do on the stock market that there's a different psychological process that goes on when you're expressing a bullish view. It's not quite the same as when you put your money on it, but I try to make sure that I'm giving you ideas that I put my money on all the time. But there is a hedging that goes on when the market's going up a lot like it is right now. People, by and large, who are writing newsletters have a tough time being bearish in the face of that because you look like an idiot and then you lose subscribers and et cetera. So I think that's not quite as good. Money Manager reported allocation, and what we see from the Bank of America Merrill Lynch Fund Manager Survey stats, I think is really interesting material. I'm hoping that it's not too widespread at this point. ETF asset flows, RIDEX asset flows, and equity fund and bond fund flows tell you a lot. For instance, last year we had a situation where we had money going from the stock market to the bond market almost every week for like 6 months. That certainly tells you something. Over the course of this cycle as a whole, I think that the obvious point to make is that this has been defined by the concept wall of worry in an almost cliche fashion, and that shows up in the sentiment data along the way. It's the most hated bull market in history. That is important when you think about those turtles, right? Everybody thinking the stock market is rigged, things like that. Now, it is rigged, and I'll show you how, but in a different way. It's a different statement. It's nobody trying to do it. It just happened. And I'll talk about that in just a moment. But the dynamic has been constant bearish extremes, every little pullback. If I could characterize it, that's the simple way to characterize it. This whole cycle, any little pullback, we constantly immediately get to the point where everybody's sure the top is in. And I think we're starting to get past that just now. Just now. It's been 8 years. People say the longest bull market is 7 years or something, and it has to go down. That doesn't really matter. Time doesn't matter. What matters is, have we completed this cycle? Have we come out of our shells? Have we taken on too much exposure and too much risk? That has to happen for the cycle to turn. So it doesn't matter how long it's taken. When every tiny little pullback, you get a bearish extreme in the sentiment data, the cycle's not over. Okay, so here is the two arrows, right? They define things for me right now. They define the narrative, and I'm going to show you these are the two most important moments lately to me to really give you a signpost, a clue to where the cycle is. There is June, July 2014. That's when actually the inflection happened as far as the Fed tightening. That's when Fed tightening started, and I'll show you that in just a second. And then right out of Brexit, there's a ton of stats I can show you. It's one of the most prolific bearish extremes you're ever going to see. It's the bottom of a bear market. It really is. I know it looks ridiculous to say that on the chart, that the second red arrow there is the bottom of a bear market, but I can show you. Okay. All right. So, and it's more like a mid-cycle slowdown. And this cycle that we're in now may not necessarily last that long, but the point is, if you were shorting off Brexit, I'm going to show you what you were running into, and you're going to kick yourself. All right, so this is the closest thing we had, June 2014. It's the closest thing we got to that's kind of like a sort of bullish extreme for the stock market. The VIX got down to 10.29, it's the lowest since like February 2007, I believe. And the Investors Intelligence one, which again is the newsletter writers, so I don't think it's quite as important, but that reached its highest bullish reading of the whole cycle in June 2014. And so that was going on. But the more important thing, I think, that was happening there is this thing right here. So this is put out by the Atlanta Fed, and it's a measure, I think, created by two people, Wu and Jia. So it's called the Wu-Jia shadow rate. What it is you take the overall cost of credit and expectations for coming rates as a function of choices the Fed is making, and you can construct an index out of like euro-dollar futures and options on short-term sovereign debt, something, and it creates an index which shows you essentially Fed policy below the zero lower bound. So below it, since you can't really get those interest rates down below that, this shows you what QE was doing. And the place where it inflected, where it maxed out and it turned around, was June of 2014, when we had that kind of sentiment extreme. Right? This is when suddenly there was tightening. The Fed is actively involved in this process. They were turning the ship around in terms of the plumbing of what they're doing. Okay? And now I want to show you the impact of that moment. And this is why I think it's such an important moment. The black line right there, that vertical black line, is that moment when the policy turned around, and it's that moment when we had this kind of, people aren't worried about volatility, the VIX was at its lowest level, et cetera. And you can see the green line, that's the dollar index. The blue line, that's crude oil, right? So when the Fed starts tightening, the dollar takes off, crude oil crashes. The red line is euro-dollar 90-day futures. That just shows you sort of the path of policy that's happened since then as far as the true effect of what the Fed is doing and how that extrapolates into expectations in the marketplace, right? Futures bets on what the Fed is doing. So you can see this is the turning point for all of that stuff. And I think here's another interesting way to look at it. This is the same to the dollar in green, crude oil in blue, but the red line is the Shanghai Composite Index from China. And you can see the bubble that it went into. And of course, the Fed couldn't have known that that's necessarily what's going to happen. But when you think about it, China is the biggest importer of commodities on the planet. Commodities suddenly start bolting down. China is also an export-driven economy still, despite their best efforts. And the primary export market is to United States consumers. So when the dollar starts to strengthen like that at the same time, so suddenly everything that China is selling is much cheaper for us to buy. So their costs went plunging down in terms of the cost of commodities, and their customer suddenly felt richer, right? And so you can see the boom that happened. It clearly is driven by this dynamic. You can see that there's no way this is an unmistakable level of correlation. And of course, that led to a crash because they got way too excited about it. And then I've never seen anybody handle a policy situation worse than the Chinese did on the other side of that mountain. But more of that in a moment. So now I want to fast forward 2 years. Okay, so we had the June 2014 critical point, and now we're going to move to June 2016, 2 years later, what we just went through last summer, and how that fits in, and this really important moment that sets in play everything you're dealing with and watching on a daily basis. So what we went through for those 2 years, right, the official end of US QE, the start of ECB QE, the explosion higher in Japan QE, negative interest rates everywhere, 5 quarters of earnings contractions for the S&P as the commodity sectors blew up, right, the oil crash, questions about bank commodity loan books. They were lending to all these oil players, the shale players, and the shale players suddenly couldn't produce at a profit and had, $1 billion of outstanding debt that they're servicing. So who lent to them? Banks. So the banks are suddenly under fire. A historic 5-day crash in the Dow Jones. I think it was 5. It might have been 3 now that I think about it, in August of 2015. 10% in 3 days. I think it was 3. A meaningful devaluation of the renminbi by the Chinese, right? That's kind of correlated there as they started to see the bottom really falling out of everything for them. The crash of the Shanghai, we looked at that. Near Grexit, kind of Grexit-ish, got to a Grexit-y thing. Bottom in oil. Now we're starting around the other direction. Suddenly, when you get to April and May of 2016, as we go through this period, we see a sharp rise in bank lending to households. And I think what that is, they have something called redeterminations, where they judge what they're willing to keep out of in the hands of commodities producers. And they're saying, how much do you have in the ground? Well, let's mark that to market. Now, here's what we expect your asset base really is. So should we leave you with all this credit? And oil went down to, it spilled from 50 to 26 in just like a month. And that was right preceding this sort of April period of redeterminations for the banks. And I think the massive bounce that we got off of 26, suddenly we were back at 40, 45. The pressure, I think, kind of came off for the banks at that point. They didn't see the need that they were going to have to write down tons of loans. So I think really that kind of, they made it through the end of QE, and then they made it through the commodity bear, and now they're coming up the other side. So they just started pouring tons of credit out there. Lots of revolving credit, I'm sure you guys have gotten just ridiculous credit card offers since that point. Just your mailbox is full of them suddenly, and it's, 0 APR and way more than you thought they'd give you. And this is just it's the opening of the spigot, finally. All right. And of course, the rise of the Trump wing in the GOP and the yes vote on Brexit. So that's that 2 years, and that brings us to this point. What was one of the most clear and profound kind of bearish sentiment moments for the market. Super shell mode here, and this is why I kind of look at it as sort of a bear market bottom that happened. The June B of A Merrill Lynch fund manager survey showed just 1% of all fund managers were overweight stocks, right? 2 of them. They surveyed 213, and 2 of them were. Fund manager cash levels at 15-year highs, higher than in 2008, 2009. The 20-week moving average of the retail-only buy-to-open options ratio was above 0.75. For a lot of you, that's not going to mean a lot, but I'll tell you this. That's people buying puts, just retail traders buying puts. And if you think about somebody with, their own E-Trade version of their 401k, kind of their retirement funds, the stocks they own, this is just mass hedging by private citizens. And it got to the most that it had been since basically the bottom of 2002 after the dot-com blow-up. So that was the most retail-oriented bear market. And at the bottom of it, it bottomed with the 20-week MA being above 0.75 in terms of puts to calls. And that's where we got to for several weeks at the same time, this Brexit period. The American Association of Individual Investors' 5-week moving average of bullishness was under 25 for 6 consecutive weeks. That's like 11 weeks where basically, so what that survey is they ask a bunch of people, do you think the stock market is going to be higher or lower 6 months from now than it is right now? So less than a quarter of the people they surveyed for basically almost 3 months thought that. So that's just a tremendous amount of insecurity with buying stocks. So what we know through all these stats, the 30-year bond futures, largest spec net long position, everybody betting on bonds, $100 billion going into bonds for the first 6 months of the year. Bond fund inflows, all but 2 weeks. This is all just like a crowded absence, if you think about it that way. Brexit happened. This is all the case before Brexit. Then Brexit happened, this terrible thing that was going to crash everything. Right? That happened in a context where all the people who would be kind of in charge of buying stocks if we were in a speculative stock market were completely out. Right? I mean, the stock market was floating on a sea of money that was not speculative. It was not cyclical. So this is when I said earlier that there's a way in which you can kind of see things as rigged. Not really rigged. I mean, what you have there is money spilling over from fixed income by sovereign wealth funds, endowment funds, pension funds, insurance companies, who all got pushed out of bonds by the Fed, the ECB, and the BOJ. At the point we got to Brexit, with all these bond inflows, interest rates were at the lowest level ever. And 70% of all sovereign debt for the OECD world, the sort of developed markets, the big established world markets, 70% of government debt was trading in negative territory. That even out to the 10-year, right? So if you are a sovereign wealth fund and you need to generate some kind of return, or an insurance company, or an endowment fund, you have to buy stocks. You can't know you're taking a loss. You have to do something with what you have. And where you can't just, bonds are yielding less than zero. This is like a sea level rising, right? And if you think of the stock market as like a rubber ducky, the water pouring into the bathtub that's not normally into the bathtub was just holding that rubber ducky up. And even though all your next door neighbors were out of the stock market, and even all equity fund managers were holding 15-year highs in cash, and only 1% of them was overweight stocks. So that rubber ducky is riding on nothing but non-cyclical money. So as soon as we get past Brexit, as soon as the market doesn't crash, suddenly we've got that uncertainty in the rearview mirror. And now, we realize it's going to be this complicated process, and it could take years before they actually leave. And who knows, but the stock market didn't go down, right? And you've got this credit swelling. Commodities have bottomed. Suddenly, energy stocks are flying. right? And who do you think that was? That's all these people who are out looking for something to get back in. And that type of bottom, I mean, that was like, here's what we had, right? And you can look at this weird little bear market that followed the end of QE. We're breaking up off of that low right now. And that really gives you context. If you're reading all these newsletters of people saying this historic crash is coming, that may be, but it's not because we're in a speculative bubble in the stock market. I can promise you that. All right, we just don't have that kind of situation. If bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria, then where do you think we were in that process just after Brexit? I mean, skepticism at best. So I think we're in optimism now, essentially. We're not in ridiculous overblown euphoria. Valuations are what they are, but that's because of the sea level rising in the bathtub, right? That doesn't mean that it's a speculative bubble. It's just a weird source of funds. And it's interesting, as you see interest rates go higher, this is going to start to become an issue because suddenly all these non-cyclical players have somewhere else to go. So there is that interesting dynamic, but just understand it's not a speculative bubble. Current sentiment data outlook. So I can just cover that real quick. I mean, there's true extremes a little bit in the VIX and the VIX term structure and in the Investors Intelligence Survey, same as we saw in 2014, right? But you see nothing like that in the types of extremes you'd normally see when you've got this crazy speculative fervor in the stock market. Nothing is there otherwise, right? We don't see that kind of picture from all these other key indicators. So sentiment data, it doesn't really give an edge. I mean, when everything is kind of this middle ground with a couple things that are flashing outside of the range, you're not going to find an edge to put on a trade based on sentiment data right now. If I had to guess, I would think that if you see everybody overweight equities in one of the BAML surveys and you see very low cash and you see no hedging by anybody anywhere, that's probably what it's going to end up looking like when there's a real kind of top-ish thing coming into play. But we don't see that. Now I want to look ahead at two things that I think are going to be hugely, hugely, hugely important, much more important than maybe people realize now. And I think the things that you hear about a lot don't end up causing much of a difference to the stock market. So like whether or not Trump gets the tax reform through right away or whether or not we get the fiscal stimulus bill, everybody's looking at that, everybody's analyzing it, picking it apart. So I kind of think that all that stuff is sort of being kind of codified into the price of the market. But these two things, I don't think they are, right? I think that, let's look at it real quick because I think that this could be more important and in both directions. Here's the worst case scenario for the French elections. This is coming up in April and May. So Marine Le Pen is currently favored to win in the first round. She is a big laggard in the second round when it becomes head to head. She wants to leave the Eurozone. There's lots of obstacles to stop her from that. But I'll tell you what, if this election goes through and it's a surprise, like Brexit, like Trump, where it seems to be that there's like a movement, a grassroots movement under the surface, whatever the source of that is, I think that it's going to become seen as kind of like a referendum by the French people that's de facto. And it's going to change the way that current lawmakers are really feeling about, are they really going to viscerally defend membership in the euro if they feel like they really don't have the mandate of the French people behind them. There's lots of things they can do in the court system there to just kind of force it through. So there is a chance that she's going to win, and there is a chance that if she does, the French are going to say, that's it, we're out of here. And if that happens, I'm going to tell you right now, there is a 0% chance the euro will survive that. It will not. There's no way that Germany is going to go along with that. France will devalue. They'll go to the franc. $2 trillion. That's their debt level. They're going to put that in francs to the extent that they can. You're going to have huge outflows. Money's just all going to go from France to Germany, right? And if the Germans are anticipating that that's going to lead to a breakup, they're going to get out in front of it. Because if they don't, their containment moves are going to be implied risks from the Bundesbank to the EMU. They're going to be holding up the whole system with money that their people, right in front of their own election, will believe is never going to get paid back. There's no way that's politically feasible. So then you're talking about the euro just dissolving, right? You're talking about sovereign defaults probably in Italy, in Greece, in Spain, in Portugal, in France. Can you imagine? So that's going to be pandemonium if that happens. And I think that gradually people are going to, as we get closer and closer to it, realize there's maybe a 10% chance of all that horrid stuff going on. And that's tough to get, to put as your primary thing that you're going to be doing. But there's only a 10% chance of it. I see somebody saying it seems like a good short, but if it's most likely not going to happen, let me take the other side of that argument exactly to the individual who just said seems like a good short, because there's this way of looking at it. There's a 90% chance of not Le Pen, right? And if not Le Pen, you're going to end up with France having its first pro-business leadership in decades. And right now, because everybody knows France is like the plague and Europe is like the plague with it, the underexposure there is like that Brexit situation for French equities. And if you suddenly get out of this with your first pro-business leadership, your reforms going through that kind of process, then I think that you're going to have this waiting repair, right? Global money managers who have been massively underweighting France into this are going to have to suddenly change their entire view on it. And again, there's a 90% chance of that happening. So I think, yeah, it seems like a good short, except as far as what this is going to set up as far as dominoes, I think that there's kind of a moment here with France. It's going to be, a move to solidarity, or it's going to be a move to separation. And I think that it's going to be infectious around, because suddenly if you've got pro-business leadership in France, and you've made this statement, this sort of referendum that we're in, I think that's going to affect how the Germans move. I think that's going to affect how the Dutch move. I think that's going to kind of affect things. It's sort of like a decision point. To me, I'm looking at it that way. So I think it's actually interesting from the other side of it, because it's not going to be an immediate repricing. But as long as you understand all of the dominoes that could fall, if not Le Pen, I think you're going to have plenty of time to say, here we are the next day, and we've got a new regime in charge in France, and it's not Marine Le Pen. I think you can just, you're going to have an opportunity there to really see a lot of outperformance from Europe in general, from the euro, and maybe we'll have a dollar top come into play. This kind of feeds into everything. In 2014, we saw that dollar top. We saw what it did. Dollar bottom. We saw what it did. Now you're coming the other direction maybe a little bit, and maybe we're going to move back in the other way, and as far as what you're seeing from commodities and commodity plays. So it's huge anyways. I think it's an enormous factor that's coming up, and it's not quite being talked about that much, but it could have implications for absolutely the whole world of investment. And that's coming up in April and May. So there's 2 rounds. First round is kind of a group thing you want to be placing toward the top. And then the second round, unless you have more than 50% of the vote, they got a bunch of candidates running, and whoever is the top couple, basically going to go head to head in the next round. Okay. So at this point, it looks like, by far and away, 60 to 70% of people in France will vote not Le Pen, just to vote not Le Pen. I don't think the first round matters much. Whoever it is that's taking on Le Pen, most people just want it to not be her. But again, we've seen this with Brexit. We saw this with Trump. There's a massive grassroots kind of marketing effort that's going to start. That engine on social media, that engine in the fringe news, that's going to start up there. And it's going to, I think, be closer than people think right now. So you've got hedging in front of that, because people are going to suddenly start to go, oh God, this could be suddenly, more than a 10% chance, and that the hedges are going to have to be huge. So that's going to drive things in front of it. And then you've got the reaction after it, when probably this is a different culture. We look at the UK, we look at the US. Continental Europe is fundamentally different, but a lot of the money that's going to be at play here is going to be money in New York and London. And so they're going to be thinking about what they just went through, and that you can't trust the polls, and that, oh no, there's a scandal in the establishment which can't be deflected as easily as the scandal in the counterinsurgent or in the insurgent disestablishment, right? So they're going to see this pattern starting, and I think it's going to lead to this real crowd out. And I think that it's not going to work that way when the game actually plays out. And when that happens, and it doesn't work that way, I think it's going to be a huge opportunity in Europe this year. I think it's probably going to be the big trade of the year around the world, is going to end up being the post-French election, long Europe everything and long France thing. That's the way that it looks to shape up to me, as far as the turtles in and out of their shells and everything that's going on everywhere else. And now the next one that I want to look at here is China, and what we see as a very well-defined and elegant argument by a couple big hedge funds who have apparently done a great job of looking at the plumbing of the banking system in China, and there's a bubble there that's worse than anything that we saw in 2008 in the United States or elsewhere, I guess by a factor of 3 or something. And so there's huge bets on the idea that the only way to deal with this is to do kind of like a realized loss cycle. China is going to have to say, okay, we cash in. We're basically going to have to go ahead and mark off a ton of bad debt, and then we're going to devalue the currency and we're going to recapitalize the banks. It's sort of like there's nowhere to go. They're painted into that corner, and if they can delay all they want, but eventually they're just going to see more and more foreign exchange outflows. Money is just going to kind of keep sneaking out of China ahead of that happening, and it's going to sort of do the process for itself. That's the theory, right? However, that assumes a certain growth environment, and if that growth environment is improving, that changes that a little bit. And I want to point out a couple things here. The renminbi is already devalued quite a bit, and with all the talk of FX flows out of China, nobody owns China. Okay, I mean, like if you try to do a PE ratio on China, I've seen it done counting A shares of like 7.2, right? And this is the highest growing big economy in the world. If you look at the FXI ETF, you see what Americans think of it. It's just all outflows since they really botched things in 2015. And you see in these surveys of different fund managers, it's one of the things that they're really worried about. So probably they're not overweight China. Whether or not the data's there, I can kind of see, it's likely that given where valuation ratios are and given where fund flows are, it's pretty clear that underweighting China and being unexposed to China is itself a kind of crowded trade. Okay, so that's the thesis here. Now, it's also the case that later this year, it's already kind of been floated out there. It looks like it's going to happen. China is going to be added to the global bond indexes. And what that means is you've got bond fund managers who manage literally trillions of dollars, and they don't have any exposure to China. And China's probably going to take a big weighting when it gets added. So just to index for their performance, for their beta, they're going to have to suddenly put like 5 or 10% of the money they're managing into China. And if the problem here is that China's going to see a kind of checkmate because of FX outflows, if this happens, that the actual re-indexing and the application by bond fund managers is not going to be till next year. But we're talking about 5 to 10% of trillions of dollars that end up pouring in buying Chinese debt. Okay, and since China's actually yielding much higher than most of the other big heavy-weighted components in bond indexes, it actually has a yield, right? So it's going to be the performance driver for the index. Like how you do is going to be dependent upon whether or not you're willing to take a chance and overweight China or at least equal weight China. So it's really tough to say, okay, it's been added to the index, but I'm not going to do it because, you're thinking career risk at that point in your job as a bond fund manager. So it's risky, right? And I'd also like to point this out. 2016 trade surplus for China with all this talk, right? It was the biggest ever, $600 billion trade surplus. And they gradually devalued their currency through that process starting in 2015, and that's clearly had an effect. January 2017, already ahead of that pace for doing that same thing again. So they've got this kind of inflow working too, right? So, and just to understand where we stand here, nobody owns China. Their equity market, including A shares, at a 7.2 PE, is a market cap around $9 trillion. It's the second biggest stock market in the world. And it's just all basically people in China who own it. And think of the world kind of coming to terms with, oh, wait, maybe the China thing isn't going to blow up. I think that is possibly a really big deal. And the last two statements at the bottom, who owns China right now at 5 to 10%? Nobody. And even the guys like Kyle Bass and Mark Hart and these big hedge fund managers who've kind of put this eloquent argument out, and it really is very impressive, about this unavoidable collapse that's coming in China, that it's just almost like a mathematical certainty. Like even if you listen to them, they're basically saying that will create the biggest buying opportunity in history in China. All we want is to see that. So they're sitting there massively short the renminbi. The devaluation happens, and those guys even say what's going to be left there is this sort of Minsky moment purge, right? You're going to be past this. So you think of like what the stock market looked like in 1987. You get that, and then from there it's just nothing but up. And even they kind of admit that feeling. So the way that I look at markets, I kind of think that makes it tough to really get the move they're looking for. I mean, if you know that it's a crowded absence right now, and it's going to move to a crowded participation point 3 years later, and the period in the middle is supposed to have this calamity. They may need to clear things, but when they clear things, it just may not have the kind of serious impact. You know, it may be just something that sounds really big and crazy, but it's a weekend news story. I understand the implications of that, and I understand how much deflation would be exported to the rest of the world if they devalue. I'm just saying, the gut feeling here is that it's not going to kind of work like they think they do, like it will, but I'm not exactly sure how. And they do know more about the situation than I do. I'm just giving you some balance. And if this does, let's say they do it, then you want to look at China because nobody owns it already. But if something starts to look like this is going in the other direction, and you start to get hints from these guys that maybe they're starting to cover, you know, this is really going to be a dramatically interesting opportunity. So, and to look at this strange thing, right? This is FXI. This is the main way your next door neighbor understands investing in China. They really botched things in the middle and the second half of 2015 by doing these crazy rules. Shanghai started to crash. They came in, they said, you're not allowed to leave. You know, they told people, high net worth investors, they weren't allowed to sell. They kept shutting the market down in the middle of the day if it was going down too fast. In the West, we don't like that. We look at that as even scarier, right? We look at that as something that's the main reason why I'm not buying, because I can't get back out. I don't like this irrational overlord of my decision making. All around the world, people just stopped. They just got rid of China. They just said, all right, we'll come back later. And mixed with the Kyle Basses of the world and the Mark Harts of the world putting out this argument, I think that it's just led to this kind of evacuation. And you can see the outflows there. I mean, this is the money flowing in and out of FXI. And since that point, since that crash, I mean, there's nothing above that line. Everything has just come out. So that's what I got today. As Mike said at the beginning, I post under ChartTrader. I post under ETFXX. About 15 minutes before the bell every day, I post my ETF daily notes. It's really just a macro note, what's going on that day, what I'm interested in, updating a narrative. And then once a month is the big picture, kind of here's the state of everything, the you are here, and I cover all the data points. For instance, around Brexit, I put the big one out called Exiting the Show, right? I said, from here forward, we're going to be exiting the show. This was that moment of, you know, and I listed the same bullet points I showed you. So I track those things. I post them all in my chart book, and I update them every day. And then under my chart ticker, I also post explicit trading calls. You'll see cited risk, targets, and commentary. There's me. Feedback. I do post stuff to Twitter, but it has to do with briefing.com. Scott and I manage Twitter mostly throughout the day. Anyways, so here you can get in touch with me anytime. You can send the team a message anytime. I think it's really important to understand that our service, the way that we do things, we mean for it to be much more interactive than you may realize. So, you know, we want to talk about it. I'll talk with you on the phone if you want to talk. You know, shoot me an email anytime. There's my email. If you're a subscriber to Briefing Trader, that's access to the traders. Look at it that way. And I don't think that people take advantage of it to the extent that they can. So I just want to make sure you guys understand that. And, okay, we can do a Q&A now. And, oops, let me figure out how to, so I think this is going to be kind of tricky maybe. And know that everything you send in as questions right now, I will be, you know, I'm going to go through this and send you emails if you leave your email address as well, or email me your questions. But I'm going to try to get through a couple here. We talked about when the French election is. I don't know much about the Dutch election, honestly. These two events affect the U.S. markets. That's a good one. How are they going to affect the U.S. market? That's the main question, right? Okay, so let me just look at markets here. All right. Remember what we, in fact, yeah, there's a better way to do this. Remember these charts? So what happens in currency markets has a massive impact on what happens to everything else. You see what happened to crude oil when the dollar started to take off in this rip. So wherever there's a vulnerability in the commodities complex, if there is a vulnerability, and you start to dramatically change the denominator in the price function, it's going to have a huge impact. And you saw what that did. Look at the opportunities in energy stocks that Scalp Trader and Commodities Trader took advantage of so well. last year. I mean, you saw these dirt cheap things, and once you comb through them and you see where the good bounce sheets are, it sets up your whole year. But you have to understand the macro interplay there. And if the euro collapses, right, if there's no euro anymore, the pandemonium of that is going to just, I mean, it's going to be very difficult for us probably to avoid a global recession, I would think. But if it doesn't happen and everybody's out of Europe, so if we do not see, if we get the result that is not Le Pen, I think that you're going to see a major appreciation. You're going to see investment flow into Europe. And if that happens, that's going to increase the value of the euro. The euro is the biggest part of the dollar index, so you're going to see a decline in the dollar. There's no way around it. That sets up commodities long side strategies. That sets up all sorts of things. That also sets up a different kind of relationship with trade for Donald Trump as he looks at, he's the zero-sum guy. He wants to see a weak dollar because that means we're going to compete. He just thinks about exports, et cetera. He's going to suddenly have this whole thing to work with. So it matters a lot. Short U.S. 30-year bonds, honestly, I don't, in front of the French elections, because I think that you're going to see a spread. So the question is, do you believe it's a good time to go short the 30-year bonds? It's like going short TLT. And I don't think, I was short the bonds, right? We made about maybe 150 ticks on a ZB short in the futures a few weeks ago. And you know, I was looking for a momentum continuation. I was short the bond market on our site in August of last year. We caught the majority of the big move down in the bond market. But I got out before the election, so then the acceleration on Trump, we didn't catch that, but we still got everything into that. So I've been bearish on bonds. I mean, that's the point of me saying that. Right now, however, I think you're going to see a spread of French debt to everything else when we start to see that kind of grassroots marketing machine move into the French picture, and we see something the equivalent of like Breitbart News covering the French elections for people there who want that. I think you're going to see a difference in how people are viewing what risk there is there, who live in the United States and in the UK and in China and in Japan. Maybe they don't understand continental European society, but I think there was going to be too much correspondence to the psychological experience of what we went through around Brexit and what we went through with Trump. You're going to see sort of signposts. Oh, I remember seeing this kind of thing. And then the polls will come out and say, nah, don't worry about it. But then they'll be like, well, that's what the poll said into, November 8th. And look what happened there. Or the polls in Brexit. I mean, people don't trust the polls anymore. So there's not something to reassure them as it gets close. And if they see other things that are going to remind them, I think they're going to act on that. And I think that means probably that there's going to be a spread of French bonds to German bonds, but also to U.S. And so I think it's going to be tougher to get that short going, but maybe right afterwards. Okay. Short French bonds getting near the election. Yeah, you and everybody else. So Mohammed, hey Mohammed, how you doing? I think short French debt in front of the election is going to be a guaranteed crowded trade, but it's probably, still going to move. I guess it's a tough one though, because you're not really judging based on things I normally judge on. We know it's crowded. It's tough for me to go along with crowded trades. Do I have an opinion on the impact of a trade deal with the U.S.? I think the terms are what matter because we've already moved. That's kind of another structural force now, kind of a new one. The fact that we're going from global trade pacts to bilateral zero-sum relationships, everything is going to be in the details of the particular deal. So, that's outside of the frame of reference of any of the tools that I use to analyze things. That doesn't really depend upon market analysis or sentiment analysis. That depends on two guys sitting across a table, and I don't know what they're going to say to each other. So I'm going to go ahead and wrap it up there. And if you send me other questions, you've got my email, right? Put it there again. bmanning@briefing.com, or you can send to mmidland@briefing.com, and I will get back to you on everything you send me. All right? And Mike, do you have anything else?
No, I think you covered quite a bit. Yeah, great presentation, Brett. Yeah, if you have any questions or you guys think of anything later, you can just email Brett tomorrow or use the Talk to Us button, and he'll get back to you. We'll post it live on the site. So, yeah, that's basically it. Thanks everyone for joining us today.
Yep. Thanks, guys.
All right. Yep. Thanks.